The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A CPI report that likely checked a lot of boxes for the Fed and maybe a couple for investors, too. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. You know what I'm going to say?
No.
Nothing burger.
Oh, my gosh.
It was a nothing burger.
Does anything go in this nothing burger?
No, that's
avocado?
why it's a nothing burger.
Oh.
It's a boring nothing burger. That's what the CPI was. Confirmation bias. Volume super light. S&P, yes, we're around the highs of the session, but going nowhere fast as volatility continues to come down. It did not seem to be the mover that we were all psyched up to have it be, Romaine.
Yeah, but look, I mean, it may have been a little bit of a nothing burger, but there was something significant here because it really was the first time in 3.5 years that we saw headline consumer inflation growing at less than 3%. We've come a long way from that 9% CPI report back in mid-2022, and we're now well below that 5.5% average over that same stretch. Now, while the Fed's fight to rein in inflation is still a long ways away from mission accomplished, David Kelly at J.P. Morgan is encouraged.
I think this is further confirmation that inflation is gradually whittling away. People are looking for, at this stage, they want, okay, if we get a negative surprise in inflation, then maybe we can price in some more Fed rate cuts. If we get something close to expectations, then we'll sort of sell the news. And I think that's what's probably going on in the bond market.
Well, for what it's worth, that bond market selling is still largely confined to the shorter end of the curve. We see that reflected in money market fund flows as well as in dollar funding spreads. Meanwhile, you have that overnight index swaps showing that traders are pairing expectations for a jumbo Fed cut next month, now lowering the odds for a 50-point reduction to just around 1/3. Now, still, the disinflation story, it does remain intact. It is a long-term story, and that might be part of the reason that you are seeing a pickup in consumer staple mergers. Remember, when food price inflation accelerates, so too does the revenue for packaged goods companies. But when that pricing power ebbs, well, you get announcements like what we got earlier this morning. This is where Snickers candy bar purveyor Mars agrees to buy Pop-Tart titan Kellanova. That's going to create a $63 billion behemoth that, in theory, should be able to resist any push from supermarkets for lower prices. That might not be music to the Fed's ears here, but something we are going to talk about a little bit later in the show.
Yeah, you know what my question is? Do we get chocolate Cheez-Its? Take a second. No, take a second. That could be really good. So here's a chart that kind of shows what Romaine was talking about in terms of Fed expectations, right? The green line, the blue line is what you want to see. That's what the market is expecting the Fed to do at the September meeting in terms of a cut. And we're now at a cut of about 32 basis points. So we are a far cry from that 50 that we saw maybe a couple weeks ago, but we're still over that 25 basis point cut. And throughout the whole year, we're still looking by December, 100 basis points of cut. So there still is this disconnect a little bit there in terms of what the market is expecting versus what the Fed might actually be saying, Romaine.
Absolutely. Those CPI numbers coming in today, not quite the positive surprise that we got on PPI, but for some investors enough to keep them in the game. Sarah House is managing director and senior economist over at Wells Fargo, joining us to kick us off to the close. On the CPI day, and when you look at these numbers here, I know the incremental changes were relatively minor here, but when we talk about that longer term story of a disinflationary trend, did this give you enough evidence, this report, along with all those that came before it, that disinflationary trend is still intact?
Yeah, I think we did see enough evidence of that. I'd say if you want to quibble with the report a little bit, the details showed that I think the overall picture from the pandemic and the recovery in price trends is a little bit more drawn out, where you continue to see much more goods deflation, including in used cars, whereas you saw the uptick in shelter suggest that just maybe some of these pandemic effects are taking a little bit longer to unwind. But I think in general, with a lot of the year-over-year numbers continuing to inch down, including in services, it is consistent with this slow grind lower in inflation that we continue to expect through the remainder of the year.
What's driving that slow grind? I know there's been some debate, Sarah, about how much of this drop that we've seen from that, let's just take the headline number from 9% down to where we are today, right below 3%, that really wasn't all just about monetary policy, that there were a lot of other forces sort of at work here that got us to where we are today.
Right. So I think a lot of the improvement we've seen thus far has been more of the supply side driven. So particularly as we've seen supply chains improve and become much more functioning than what we were seeing at the height of the crisis. So if you look at the drop from inflation since its peak, the bulk of it has come from the goods sector, but we are starting to see the services side decelerate as well. And I think that does reflect in some ways the pass through of the tamer physical input cost pressures, and then also benefits from greater labor supply that's reduced wage growth. But I think as we get to the next leg of this disinflationary cycle, I think it is going to have to come down more to what's happening on the demand side as we've seen the supply side improve more slowly. And so I think that's going to be really important to watch, and particularly as we think about what's happening in the labor market, what's driving the next leg lower of inflation from here.
Right, and if it's demand, then that's even a bigger signal to the Fed that they got to cut. The market's still pricing in terms of WIRP, 100 basis points of cuts so far this year, which means we're going to have one supersized cut. Is that legit?
Yeah, I think that's pretty reasonable, especially when you look at what's happening in the labor market, where we have seen, I think, pretty clear softening across a whole host of indicators. This isn't just about the July jobs report, but when you look at the labor market, by most indicators, we're back to where we were before the pandemic, if not even more of a mid-2010s position. And I think if the Fed wants to stop that downward momentum, that we do need to see some fairly fast dialing back of the Fed policy rate. And so we think that's a 50 basis point cut in September is still pretty reasonable. But of course, we'll get one more inflation print and one more jobs print before then. So the debate's far from settled.
The other debate is if they cut 50 basis points, that means something's really wrong, and that's going to freak out markets. Is that the other side of this coin?
I don't necessarily think so, and I think this is what will make Fed Chair Powell's Jackson Hole speech very important, is if he can lay out the reasons why that it is appropriate to dial back the level of restrictiveness, that they're not adding accommodation, that this is really a normalization of the policy stance. I don't think it has to be a message that things are going really wrong at the moment. It's actually that policy is working and that conditions have normalized enough where the policy rate can normalize as well.
Just curious, looking ahead, Sarah, obviously we get the big Fed meeting on September 17th and 18th, a few data points in between that. We also get Jackson Hole next week on the 23rd. Do you anticipate at all that Jay Powell will try to articulate what the Fed is going to do next in that Jackson Hole speech?
I don't think he'll try and articulate exactly what the Fed's going to do, but I think he will try and explain their reaction function and maybe how they're thinking about the overall stance of the current policy rate against the current economic data, where we have seen inflation slow, roughly 1.5 percentage points since the Fed last raised rates. We've also seen the unemployment rate move up pretty noticeably over the past year. And so I think it'll be more about explaining how the Fed is thinking about the current stance of monetary policy, and that there is room to remove some of the restrictiveness at this time, but not necessarily become accommodative.
All right, great stuff. Always smart. We'll let you get back to work. Sarah House, senior economist over at Wells Fargo, kicking us off to the close here on this Wednesday afternoon. Coming up, third time's a charm. Victoria's Secret getting its third CEO in the past 4 years. Investors, though, seem to be pleased with who they chose.
All right, plus we are counting you down to earnings after the bell with Cisco set to report. We're going to bring you the numbers right as they cross.
And we continue our focus on the health of the consumer, diving deeper into Walmart's results scheduled to drop tomorrow. A deeper dive into that and so much more. Stick with us. This is The Close on Bloomberg.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
S&P goes nowhere fast today. Bank of America out with a note saying if you want to buy the rally, go with the equal weighted index. Lower risk, bigger discount relative to the S&P, and better earnings picture than the Russell 2000. Joining us now for his take, Jason Trennert, Chairman and CEO of Strategas Research Partners. Jason, always a pleasure. If you want to play the rally, is that the right way? Equal weighted?
I think so. I think this is the time where you want to leg into more of the equal weight versus the market cap weighted. I think we're seeing that in the earnings, right? Because until recently, most of the earnings were really just coming from the handful of stocks that were going up. But one of the things that was nice about the second quarter earnings season, at least thus far, most of them report except for NVIDIA next week or next 2 weeks, is that the earnings situation has broadened out to include more companies. The comment that was made about the Russell 2000, I think, is also interesting because we found that more than 40% of the companies in the Russell 2000 have not had a profit in the last 12 months. This is largely a hangover of QE. There's been a lot of zombie companies. And so going into smaller market cap and large cap makes sense to me.
So from that perspective, what does that imply on the volatility front? Like, does volatility then pick back up, or does it continue to go lower? Well,
I think it's likely to stay higher, and it's largely because those top 10 stocks are still 37% of the S&P 500, right? Or 36%. It's just off the boil a bit. So to the extent to which they're unlikely to produce the types of earnings gains that they have in the past, it seems to me there's more risks there. You'll see more volatility in those stocks. Great companies. I wouldn't short them, if you put a gun to my head. But I also think that there's going to be more action in the more equally weighted lower cap stocks.
Well, when you look at some of those lower cap stocks, and I saw some data out by our analysts here at Bloomberg Intelligence saying that this is going to be the first quarter we've seen the Russell actually an aggregate of post profits in I think like a year and a half or 2 years almost. But it gets to the question here about why it's taken this so long. And didn't that have a lot to do with concerns about economic conditions, or at least the fear that if the economic conditions didn't improve enough, those small cap companies, particularly those that were over leveraged, didn't really have a fighting chance?
Yeah, no, a lot of this, and a lot of it has to do with long-term interest rates, really, at the end of the day, right? So what we've found is that the market does a lot better. Anytime the 10-year Treasury is below 450, the market actually is in pretty good shape. Anytime you get above 450, which hasn't happened that often, but it happened last October, believe it or not, the S&P fell to 4,100 at that point. That's when people get more concerned. I'm of the view that, generally speaking, you want to be buying small cap stocks really at the end of a cycle, or at the end of a recession, really going into a business cycle, a recovery. And I think it's hard to make that case right now. One of the other things, we talked about this a little bit before we got started, is one of the other things that's making the picture a little murkier is the fact that we're running massive budget deficits. We're running deficits of 7% of GDP at a time when you're pretty close to full employment, or 4%. We've never run budget deficits of this size when we either weren't at war or when the unemployment rate was below 7. So there is a little bit, I think, of economic growth, which is you have to wonder how sustainable it may be, and whether at a certain point long-term interest rates will short-circuit it.
That's sort of a kind of a pull forward in economic growth, and that has to be smoothed out at some point in theory, and at least in theory. That gets to the question, though, as if that is true, do you generally believe, though, that the long-term trajectory, and by long-term I'm talking really over the next, say, like 5 years, that interest rates are going to be lower than, I guess, where they were like towards the start of the year? Can you bet on that?
I'm not convinced of that.
I'm
really not. And that's largely because it really depends on whether the Fed does QE again. But in the absence of QE, it seems
we're done with QE.
Right. Who knows? But it seems to me it's unlikely, and that's partly because of just the supply of Treasury bonds. And the other part, as you may know, is that we have, for a long time, been issuing short-dated debt. A third of our debt matures in the next year. Over 50% of it matures in the next 3 years. So the interest expense is exploding higher, which is making it very difficult to get a handle on the debt, on the deficit. And a lot of government spending is indexed to inflation itself. So I wouldn't really plant my feet. I'm not really bearish on bonds, but I think the trend is likely higher over the next 5 years.
Which raises the election risk. How do we deal with the election in the market?
Yeah, I wish I knew, because I think to be fair, I'm not. Whoever becomes president next is, in my opinion, is going to have some challenges on their hands, particularly if you want to put the country on a more sustainable fiscal path. And I would also say, as we were talking about, to really get a handle on inflation, theoretically, you should have some coordination between fiscal policy and monetary policy. And over the last couple of years, there's been no coordination whatsoever. The Fed's been tightened very aggressively, but we've been running these massive deficits. So it's going to be tricky because it's hard to do this, generally speaking, without pain.
We only have 30 seconds left, but did that surprise you that we didn't see more coordination? Because when Janet Yellen came in as Treasury Secretary, there was a lot of talk that you were going to see that coordination given her previous job as Fed chair and her relationship with Jay Powell, but we never really saw that.
No, I have to say, though, all presidents want control over monetary policy, but I think, unfortunately, in my opinion, we've set a precedent now where we're likely to have, if I'm a president, I'm going to hire a former Fed chair as my Secretary of Treasury because they know where all the bodies are buried and they know how to manipulate the system. And I don't want to be critical of Secretary Yellen, but she's moved a lot of levers to keep long-term interest rates lower without much regard, in my opinion, about the long-term fiscal health of the country.
Yeah, that's been a common criticism. Jason, I'm going to have to leave it there. Always a smart conversation.
Thank you.
Jason Trennert, he's the chairman and CEO over at Strategas Research Partners. All right, coming up next here on the program, we're going to take a closer look at Victoria's Secret and a reason why some investors are celebrating. The CEO of Rihanna Savage X Fenty is said to be heading over to Victoria's Secret. We're going to get you some details on that in our top calls. This is The Close on Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations. And we start off with Chipotle. Wedbush actually upgrading the stock today to outperform and lifting the price target to 58. The analyst saying that the company's still well positioned to gain market share. And he's unfazed by the departure of Brian Niccol, adding that the company remains in very good hands. The shares fractionally higher on the day. Next up, biotech company Illumina. TD Cowen upgrading, going to buy from hold after what it calls an impressive strategy update where management outlined ambitious plans for revenue and earnings growth over the next few years. Those shares moving higher by about 2%. And finally, let's take a look at Intuit. Morgan Stanley downgrading the shares all the way down to equal weight, with the firm saying Intuit's revenue has become more volatile since the introduction of Credit Karma and MailChimp into the mix. Also, the transition of TurboTax from DIY to assisted presents even more challenges. Those shares down about 2% on the day, and those are some of our top calls. We do want to stay in the sell side space and move on to one of the most talked about companies of the day, and that is Victoria's Secret. The shares having their best day since at least 2021 after the lingerie retailer poached the CEO of Rihanna's Savage X Fenty brand. Hillary Super is going to replace the current CEO starting on September 9th. Victoria's Secret has been off the rack in recent years thanks to falling demand and hefty competition, as well as some image issues of its own creation. Simeon Siegel joining us right now, managing director and senior analyst at BMO Capital Markets. He's got to outperform on Victoria's Secret. Third CEO, third leader in 4 years. Is this going to be the one that finally gets him over the hump?
It's always number 3, isn't it? Isn't that the move? Just ask Howard Schultz. No, I think that right now, I didn't say that. I think right now, you have a business that has such amazing brand awareness and such low profitability. And this is a business that arguably sells clothing. This is something that if you have a large amount of revenues and a low amount of profits, that's something that should be fixed. And so I think right now we're watching the reaction to the world recognizing that this has been an underperforming and undervalued asset. And so the question of where we go from here, is it 1, 2, or 3? I don't know, right? But I think that the point here is, okay, now let's see what the next step is going to be.
What is the next step? What should the next step actually be? Because overseas sales haven't been terrible.
So you're asking an analyst what the next step is, which means I'm supposed to say they're going to juice up revenues and it's going to be great. And there's a very large business. I think they would, my own view, which is not going to be their view, but my view is I think that this business could see a material improvement in profits by doing less. I think if they sold less and charged more, they would make more money. How do I know that? Because they did it during COVID. This was a business, L Brands, which owned Victoria's Secret and Bath & Body Works at the time, was, I think, the 7th and 4th best stock in the S&P. Someone can check me. But they did really well during COVID.
Yeah.
Revenues went down, EBIT dollars went up.
Yeah.
Because for the first time in a while, they realized they could do more with less.
Talk a little bit about Hillary Super. Not a lot of people seem to know a whole lot about her, but I think Rihanna Savage X Fenty certainly has a lot of brand awareness. I have no idea what their financials are, but I even remember during the pandemic watching a fashion show that they aired on like one of the streaming channels, which was like the first time I would ever do that here. So they certainly have some cachet, and I assume that she's going to bring that to Victoria's Secret, which, as I'm sure you know, 10, 20, 30 years ago, I mean, Victoria's Secret had all the cachet.
Just to be very fair to Victoria's Secret, they had $6 billion in revenue last year. That's a lot of cachet. Like, I think we do have to internalize and give credit to the fact that the only thing that tells me how big a brand is its revenues. Gross margin tells me how valuable a brand is. It tells me how much people like it. What does it cost them to sell their goods? That's very low. They have gross margins around 36. That is way too low, but the revenues are very large.
But sorry, I just cut you off. But
please.
Do they need to focus a little bit more on the marketing aspect? Because at the end of the day, they're still selling the same stuff they were selling 10, 20 years ago. What happened in between? It seems like people just decided that there were other brands that they thought, I guess, were just better for whatever reason.
So first of all, I love when people cut me off, and especially with this kind of a point. They are still selling the same things, and they're selling the same amount. They're actually potentially selling more in certain instances because the price point has come down a lot. Okay. So if you look at this revenue, and it's a point that it's subtle, but it's important. When a company like Abercrombie & Fitch fell for the same reasons, being accused of being overtly sexual, being exclusive, all of these things that we went after, the revenues came down. When Victoria's Secret did, the margins came down. And so people are still buying the products. They just believe the brand is worth less than it is.
Gotcha.
Is Victoria's Secret doing better overseas, though, than the U.S.? Like, is this a uniquely
I don't think so.
U.S. issue? No.
I think in general, the brand, to your point about marketing, there's a few ways to elevate a brand. One is price points, another obviously is marketing, and so I assume Hillary will be able to bring that. Brings a very strong merchant element, also came from Anthropologie at Urban Outfitters, which is a much larger business. So I think being able to bring that merchandising side, but I do think my team has done a lot of work historically on where brands peak. I mean, think about it. Brands, for lack of a better word, when they get big, lose the cool factor. That's just what we are talking about. These are tangible brands that teens or older are going to buy, and if they see too much, they're going to start believing it's worth less. Sometimes doing less can help you do more with profitability. And that's why what we look for, very large businesses with very low profits.
Interesting take, Simeon. We appreciate it. Thank you very much. Thanks for coming in to Simeon Siegel over at BMO Capital Markets. And speaking of retail, you got Walmart reporting earnings before the bell tomorrow. So are they going to shed some light on how consumers are coping with inflation and rising costs? We're looking to remain at comp sales, if you back out gas, to come in about 3.4%.
Yeah, I'm all in on this earnings report. I always feel like you get a nice kind of read of the consumer, given obviously they sell everything, including groceries, and then of course the whole trade down in the economy. I guess though my question is too, and this kind of piggybacks off the Victoria's Secret conversation too, is like, do brands need that sort of buzz to sort of be big and to have that growth?
Yeah,
I thought so too.
Yeah, you definitely need that.
Okay,
but Walmart doesn't count for that. Walmart's different.
They got buzz.
It's big box.
They got buzz.
All right, coming up, we're going to break down Mars and Kellanova. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. I say it was nothing burger, but staying with food for a sec, chocolate Cheez-Its.
Okay.
I really do think this is going to be a thing. I want it to be a thing.
I hope not. I'm not much of a chocolate person, but I do like this meld up, because I assume they're alluding to this big deal.
I am alluding to the deal.
Coming up, and everyone keeps talking about how Mars was very chocolate heavy, and that by buying some of these Kellanova brands, that sort of gives it, I guess, what I would call, Alex, the more delicious part of their portfolio.
Pet food?
No, I was referring to, Pop-Tarts and all that other Pringles and all that kind of stuff.
But I am referring to that
markup. The salty
markup,
and the sweet.
Which is the whole chocolate Cheez-It thing. But Kellanova stock is up a whopping like 32% from the day before the deal was rumored to come out. So it's definitely been a nice jump for the stock.
Yeah, and it's to point out, this was rumored pretty much from the day they got spun off. Everyone said this was basically an M&A play from the get-go.
$36 billion, one of the biggest deals of the year, biggest deal in this food space of the year. Want to get more on this with Deena Shanker. She covers food and consumer goods for Bloomberg News. Deena, like we said, we weren't surprised. This had been heavily rumored, but talk us through how this deal came about.
Well, we saw Kellogg, the cereal company split into two separate companies. It went WK Kellogg, which was the North American cereal part, which is the part that has really struggled as people just eat less cereal, and every year it seems like less and less. And then the snack segment, which was doing really well, as the entire snack category was doing really well. They had originally planned to spin off a third piece of, they called their Morningstar Farms brand, which is like veggie burgers, but they eventually kept that with Kellanova because they couldn't get the price that they were looking for that. So we have Kellanova. It has Pringles, Cheez-Its, all these growing brands, and they're doing well, and they're having good earnings. And then we find out that Mars wants to buy them, and that looks good for both companies. Mars could use the balance in terms of their snacking portfolio. I will just say, I heard your conversation before I came on, and pouring M&Ms into your bucket of popcorn at the movies is very popular, and maybe now we can start seeing buckets of Cheez-Its and
Thank you. Thank you for seeing me, Deena.
As an option. So it really provides a nice balance both for their brand portfolio and some might say for the palate.
I should point out, it's funny you bring that because my wife does this at the movie theater. She gets the popcorn, she gets the Nestle Crunches and then mixes them in there. Blah, awful. But anyway, to each your own. I am curious, though, when we start talking about this idea of why this got snatched up so fast, and if it hadn't been Mars, did you have any sense, Deena, that there would have been another potential buyer for this company here in the moment?
I think that right now we are seeing what a lot of people have predicted to be a time of a lot of M&A in the food industry. A lot of these companies came out of the pandemic with plenty of cash on their balance sheet, and right now consumers are buying less at the supermarket. So growing as a packaged food company is even harder. That makes Kellanova, a growing snack company with room to grow more, a really good catch. And so, yeah, probably there would have been other buyers if Mars hadn't been the one to step up and offer such a nice price.
All right, Deena Shanker there. Of course, a closer look here at the big news of the day, the big M&A news, and that is Mars paying $36 billion for Kellanova. We continue that conversation right now with Erin Lash, Director of Consumer Equity Research over at Morningstar. She has a hold rating on Kellanova shares. I do want to start off as to whether you think, Erin, this actually makes financial sense for Mars at $36 billion.
The price that they're paying for Kellanova is quite attractive. We expected that they would pay about 15 to 16 times EBITDA. It came in slightly above that. So this does look like an attractive price. Pre-deal, we were sitting at a fair value estimate, what we think Kellanova is worth, of about $75. So it's about an 11% premium to that price as well. So attractive price, not completely astronomical or unheard of. And given the attractiveness of the portfolio beyond snacking, Kellanova also derives about 30% of their sales from faster growing emerging markets, which should enable both Mars and Kellanova to take advantage of more favorable demographic trends longer term by extending the reach of their products.
So Mars is going to be huge, and they're going to do a lot of stuff. Do you think we're going to see them sell off or sort of spin off certain areas of their portfolio that now doesn't really mix?
That's a definite possibility from where we sit. It was mentioned that Morningstar Farms in the initial split of the business last year had been targeted to be split. We think that that could ultimately come to fruition. Over the last several years, we've seen a number of packaged food firms look to slim down, increase their focus, and we think that that could come into play in this situation as well down the road.
Yeah, that's what I'm curious about, whether this bigger ends up really being better here, Erin. And I'm specifically with regards to the distribution. I know Mars already has a great sort of pipeline into whether it's to the wholesalers or into the retailers directly here. By adding these brands here, does that give them more leverage?
It would, as it relates to the reach that they have within the grocery store. there is not significant overlap in terms of the aisles that these two firms play in. So there is the ability to enhance their negotiating leverage potentially, to derive greater consumer insights across categories. And that's just on the home turf. As I mentioned, being able to do so on a broader scale would also be an advantage, and extending the distribution of their products into more global markets and more distribution channels abroad would also be another benefit.
Hey, Erin, how much of this do you think was also defense? We've made a lot of hay over Ozempic, and I feel like the conversation a year ago was how disruptive that's going to be for all the food players and drink players. How do you think this is feeding into the conversations over at Mars?
Yeah, I think that that's a very interesting point. Obviously, that has come up quite a bit more recently in terms of how food companies combat and protect themselves from evolving health and wellness trends across the space. We think that these firms, regardless of the deal or not, have the resources to be able to pivot and to be able to enhance the health profile of their products and evolve with consumer trends in time. But this definitely accelerates that and gives them, both firms, a play in categories where they didn't have exposure before. But from our vantage point, it is also defensive in terms of being able to buoy growth in a slowing environment.
All right, Erin, great stuff. Erin Lash over at Morningstar. A closer look here at the big deal of the day. Mars buying Kellanova for roughly about $36 billion as we continue to focus on food. And not a good day here for Brinker International. The shares having their worst day in at least 2 years. This after the parent company of Chili's issued a fiscal year profit forecast below estimates. Basically, the company, and I thought it was more interesting, not just their own metrics, but they're saying industry-wide, they're projecting a 4 to 5% decline on comp sales industry-wide.
Yeah. Did you, there's a great new function that I hadn't heard of called ALTD Go, and it basically looks at all the data and credit card swipes and debit card swipes. Right. And if you take a look at it on a weekly basis, year on year, they're still growing, just that growth is slowing. And like, how do you then price that in? It's happening to all their competitors too. It's not necessarily unique to Brinker.
And you do wonder, I mean, we've been talking a lot about these meal deals we've seen at the fast food restaurants, KFC, McDonald's, et cetera here. Do we start to see those types of deals at the higher end? I mean, I guess you could call Chili's higher end, but slightly higher end restaurants as well?
I mean, Chili's did really well though, right?
Yeah.
They weren't terrible, but like Maggiano's and other areas of
I haven't even seen
Brinker.
a Maggiano's in years.
I haven't eaten that since college.
Yeah.
I mean, I didn't even know they're still around, but I don't know.
I haven't been in a Chili's in a while too. I do kind of miss those. They had this little salad thing a while back.
Salad thing? They have salad at Chili's?
It was actually really good. I mean, it wasn't a very healthy salad, but it was tasty. All right. Speaking of which, let's talk weight loss drugs. Eli Lilly trying to squash its weight loss competition by going straight to the doctors who prescribe it. It's our stock of the hour. It's up next, right here on The Close on Bloomberg. Let's get right to our stock of the hour. Eli Lilly, higher by about 2%. And a new report out there that the company is sending a slew of cease and desist letters to telehealth companies, wellness centers, medical spas, and clinics, demanding they stop promoting copycat weight loss drugs. Jess Menton joining us for more on this. This looks like the crackdown that we knew was eventually going to come.
It is, and you see the stock up more than 2% today. Also, the pharma group in the S&P 500 is also getting a boost on this too when you're looking at some of its peers. But we did get indications of this because we've known very well there's a lot of shortages when it comes to those key components when you're talking about its diabetes drugs and its weight loss drugs as far as what this means. But I feel like a lot of people may not have realized when it comes to situations like this, the FDA does allow in situations where there is a shortage that pharmacies like this can have copycat type drugs until those shortages are resolved. But right now, Eli Lilly is saying that when it comes to the ingredients that go into those types of drugs, that it's better at this point and more accessible, but the FDA still has it listed as shortage. So that's kind of the conundrum that some of these other pharmacies that were selling those are in right now.
And what I was reading too, it's that not only do you have to be able to meet demand, but you have to be able to stockpile it also. And until you do that, then the FDA allows these sort of like a copycat, for lack of a better word, a drug. So it's like, what's the leg to stand on then?
Yeah, and so that's the big thing to see where this sort of stands, because tirzepatide is actually the ingredient that goes into those terzepatide is actually the ingredient that goes into like Zepbound. And then if you're thinking about Mounjaro as well. And so that's sort of the key component where they're trying to figure out. It seems as if like Eli Lilly's trying to say the shortage isn't there anymore, but that's what the FDA still has it listed there. But it's interesting because if you coming out the back, we actually just had the earnings results last week, as well as Novo Nordisk. Obviously, when you're thinking about Ozempic, and two very different stories when you're looking at those reports and the stock reactions to both of those.
Well, the other thing, though, too, I mean, just on this shortage idea, though, too, I mean, because we've talked a lot out of those earnings reports that these companies would be doing better if they had more supply. So it doesn't really seem like the issue is that other companies are stealing their lunch. It's just that they can't produce enough to satisfy the demand.
That is the thing. And then also on the earnings call for Eli Lilly, they talked about how if you're looking at the same year-over-year period for this next 6 months compared to a year ago, it's a 50% higher when you're looking at the demand for those particular types of drugs when you're talking about weight loss and diabetes. So that's also still more demand there. So how are they going to rectify that if there's potentially going to be more shortages if you still have strong demand?
All right, Jess, super appreciate it. Thank you so much. Jess Menton joining us from Bloomberg. It is kind of a head scratcher on that. I'm taking a look at markets. Yes, we were on the highs for the S&P, Romaine, but it's really financials that are outperforming because of Progressive at one point hitting a 52-week high today after earnings came in really solidly. So we're still getting that fundamental read through the market. Yeah, and you saw the Allstate also rally here on the day with a lot of those insurers and financial companies also moving on the back of what continues to be that turmoil that we continue to see in the bond market. Right now, the yields are only slightly higher on the short end of the curve, but I thought it was interesting. We were speaking with Jason Trennert earlier, and his comment that he actually thinks yields are going to end up being higher over the next few years than where they are now, which I don't know, seems to run against the grain a little bit. Fiscal issuance, that's it. I mean, the demand can still be there, but if issuance is so high, then you're going to have those higher yields. Also, if you get growth scares, that's a different story as well. All right, we're going to count you down to the closing bells coming up next with Emily Roland, Chief Investment Strategist at John Hancock Investment Management, as we take a look at the markets. Still holding up. They're looking at an S&P up by 0.3%. This is the close on Bloomberg.
I'm of the view that generally speaking, you want to be buying small cap stocks really at the end of a cycle or at the end of a recession, really going into a business cycle, a recovery. And I think it's hard to make that case right now.
Jason Trennert there, the CEO over at Strategas Research Partners here. Interesting call here on the small cap space. And more importantly, he was really kind of much more focused on equal weighted S&P here. And that's actually a better deal for investors here as they move closer to the closing bell.
And in some ways, it makes sense when you take a look at the price action today, right? The S&P is up, but the NASDAQ is underperforming in part because of Google and Tesla. There may be some fundamental reasons for that, but nonetheless, tech kind of underperforming there. I appreciate that small caps are also up by 0.6%, but not a huge dramatic move from what we've seen in the past.
Yeah, sixth straight day of underperformance for the Russell versus the broad market. And it's really a lot worse than that when you go back over the past 20 sessions here. Of course, a lot of investors still looking ahead and still seeing some potentially green shoots out there, given the inflation reports that we got this week, and maybe just potentially some encouraging retail sales numbers tomorrow. Emily Roland, she's the co-chief investment strategist at John Hancock Investment Management, and she joins us now to count us down to those closing bells. Emily, look at the economic conditions here. Is that a backdrop for further gains in the equity market?
Yeah, I mean, we've been in this environment where for a long time, bad news was good news because it was reviving hopes that the Fed would cut aggressively this year. And then we went to a bad news is bad news environment. We saw that weaker than expected ISM manufacturing number, initial claims jumping, clearly markets reacting to that growth scare that we saw. And then, well, lo and behold, the data came in a little bit better. Last week, we had ISM services surprise on the upside. We had initial claims coming in lower once again. So the market backdrop or the economic backdrop is really bumpy, really choppy right now. And that is classic late cycle behavior. Jason Trennert mentioned that earlier. So what we expect from here is, still an opportunity to own high quality stocks here, look for ones that are on sale, but start leaning into the income that's available in bonds because it's still really attractive, especially when we see these little backups in bond yields.
Well, when you say lean into bonds, is that primarily short duration, Emily, or is there any appetite to extend that, maybe take a little bit of a chance on the long term?
Yeah, we've been legging into duration more, and I think the intermediate part of the curve right now is really the sweet spot for investors. Even if rates chop around from here and inflation is moving lower, but in a choppy pattern, you can get paid to wait. In fact, the income that's available in the aggregate bond index right now is approaching 5%. We would look to lock that in and really develop a return stream for years that can be really accretive to client portfolios. Yes, you're going to get paid also owning the short end right now, but we still think there's massive reinvestment risk there, which is, a year or so from now, as rates come down, you're not going to have that opportunity to benefit from the duration component.
So, Emily, to that point, if you take that template to the equity side, is it S&P? Is it equal weighted? Is it small? Is it large cap tech? Is it mid?
So we are overweight the quality factor. These are companies with great balance sheets, tons of cash. They've got a better ability to maintain profit margins. And just to expand on that a little bit, slowing inflation is great in a lot of ways. Of course, it's wonderful for the consumer. It's bringing down borrowing costs. But there is a dark side to it, which it means that revenue growth is slowing. So as the consumer slows, as there's cracks in the labor market, top line growth for companies is slowing as well. And that means they've now got to really defend their margins. So we think that companies that have a better ability to do that are going to fare better, great return on equity, lots of cash. The poster child for that, Alex, is mega cap tech. But we still have a little bit of a valuation problem there. I think it's pretty tough to argue that those stocks are not expensive. So we also want to be looking on the value side at areas like mid cap value, which are trading at the steepest discount to large cap stocks since the late 1990s. We are underweight small caps. Like Jason mentioned, they tend to be lower quality. They have high levels of indebtedness, and they're going to be much better off in an early cycle environment. Too soon to go to small caps.
Too soon to go to small caps, Emily. How much risk, though, do you want to be taking on? Doesn't have to be in small caps, but in general, what's that risk feel?
Yeah, we would be trimming risk here. You're seeing, you guys have mentioned the Russell 2000 outperforming. We're seeing kind of growth at any price. Unprofitable companies back into the spotlight here. We think the equity market, in terms of the intra-market leadership, is kind of getting it wrong here. We do think that slowing growth is slowing growth. It's not great news anymore, and bad news is ultimately going to be bad news. So that means, looking at more defensive parts of portfolios, maybe looking at things like utilities or infrastructure. We're going to learn more from retail sales tomorrow, but it feels like we're going from this, what do you want to buy versus what do you need to buy kind of trade-off happening right now. And certainly we saw that underneath the hood of the CPI report this morning. So looking at those more defensive areas and then trimming kind of these bouts of risk-on behavior. They're being helped, frankly, by a weaker dollar that's helping international performance. We want to look to fade that as we head towards economic contraction.
Economic contraction. Emily, final question here. We spoke with Jason earlier. He seemed to think that the trajectory for interest rates might actually be higher than where they are today, at least over the next few years or so. Do you believe that's possible?
We think lower. And I think if you look at every market cycle that's happened in recent history, it's the same playbook every time. You see everything looking awesome, especially as inflation slowly coming down. Markets celebrate that. And then the music stops, frankly. Once you see high yield spreads widen, you see initial jobless claims picking up. And that's the environment where bond yields fall, and they fall pretty precipitously, which makes the math on high quality bonds look pretty awesome from here.
All right, Emily, going to have to leave it there. An awesome conversation with Emily Roland, co-chief investment strategist over at John Hancock Investment Management. As we count you down to those closing bells, and Alex, I do just want to point out, we did get some headlines out of Austin Goolsbee, of course, the head of the Chicago Fed, a Bloomberg interview where he's basically saying that policy, in his words, are very restrictive right now, but the economy is not overheating, and that he would focus much more on employment if the job market continues to weaken.
As if we weren't clear that a jobless claims are going to become more and more important. Just look at the price action.
And there was a great quote, I forgot who said it in one of the Bloomberg stories, said that basically now the Fed has moved from being dependent on the inflation data to now really just being dependent on labor market data.
Yeah, I'm also looking at earnings. We get Cisco after the bell. It feels like we're obviously going to be looking for any more job cuts. Reuters had reported that story about a week ago. And also that traditional tech spending that has been diverted to AI. when does that recover? That core networking business, when does that sort of trough and start to pick up again?
Yeah, it's a good question here. And I do sort of wonder, like, what's the relevance of Cisco in that sort of AI story?
They're wondering that too.
Because a lot of people, particularly given just their role in sort of the advent of the internet, whether they can maybe have a footprint in this as well.
Yeah, and you look at the stock, and clearly investors are very worried about that too, despite any investments they may be making into AI startups.
All right, stick with us. We are moving closer to those closing bells. Full market coverage coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic here with Alex Steele, taking you to the closing bell. It's a global simulcast, starting now with Scarlet Fu joining us in the TV studio, Carol Massar and Tim Stenovic in the radio booth. Here on a Wednesday afternoon, Carol, where we're actually seeing stocks now get a bid into the close, things flipping into the green as we get closer.
I always think that's a positive, right? In those last few minutes of trading, to see actually some buying into it. On a day or just right before, Tim, we're going to get some interesting data points.
Yeah, kind of a double dose of the consumer tomorrow morning with an update on retail sales. And then Walmart, because we are not done with earnings yet, Walmart's going to report so we get an understanding of how the consumer is feeling about the economy. Are they trading down? What are they buying? Always some good insight coming from Walmart.
So that's the consumer economy. There were some ominous remarks about the industrial economy with China Baowu Steel, the biggest producer, warning of a severe industry crisis. I was just looking at the steel makers and the S&P indexes, down 1.2% as a group.
Yeah, and that's not a good macro read for sure. But also, guys, volume is terrible right now. So I have a hard time taking any sway in where we're going with the indices. I called it a nothing burger. Called the CPI nothing burger.
Why'd you call it a nothing burger? Because of volume? Because everyone's on vacation?
Yeah, but also it was just confirmation bias. That's how I was looking at the CPI.
But I guess taken in hand with what we saw 2 weeks ago at this point with the jobs numbers. I don't know. This one's pretty Fed friendly.
Are you saying the people that are buying into the close are kind of lame investors, that they really don't know what they're doing?
No, they're probably the systemic investors buying into the close.
Just checking.
All right. Well, we look at a day here, a mixed day in the bond market. The VIX remains lower once again, down around that 16 level. The dollar relatively unchanged, and Bitcoin taking a slight leg lower. We did see a bid come into some of the equities here at the closing bell, just enough to flip a couple of the indices from red to green. The Dow Jones Industrial Average higher by more than 200 points, or about 0.6%. The S&P 500, which has been holding in the green for most of the session, is going to finish higher as well, 21 points, or about 0.4%. The Nasdaq, which was in the red just a few minutes ago, looks like it's going to close in the green, though we can call it relatively unchanged, only up by about 5 points. But the Russell 2000, it's been in the red all day, and that is where it ends, down 0.5%.
Yeah, pretty small moves there. So let's go dig a little bit deeper into the S&P 500. What you're finding, guys, is almost an even split. 293 names in the S&P 500 gaining ground on this Wednesday. Scarlett, just about 202 to the downside, 8 unchanged.
Yeah, but the majority of the sectors in the S&P 500 are in the green. Financials leading the way, up 1.3%, by far the best performers, thanks to some strength in insurance companies. Energy stocks and tech gaining about 2/3%. On the flip side, Alphabet is dragging down communication services by 0.9%, and consumer discretionary and utilities also finishing in the red, but not by a whole lot.
All right, guys, gainers, individual gainers, something to eat, something to wear, and something to do. So we start with Kailey, finishing the day just shy of an 8% gain. It is your number one gainer in the S&P 500 today. We all know the story, the merging of these two companies, essentially, or I should say an acquisition. Mars agreeing to buy Kailey for nearly $36 billion, including debt. I know mergers don't happen. I got it. Bringing together two major food companies in the biggest deal of the year. Not a surprise, right? We probably knew something was going to happen when they announced that they were going to break in two last year. I'm talking about Kellogg's and Kailey, and then said that they were going to spin it off. And so we finally get this deal. So this has been certainly percolating for some time. What, though? You guys have been talking about it with all of our Bloomberg team. It does sound like it brings some growth, though, and some growth brands into the Mars world, if you will. Victoria's Secret, 16.4% higher in today's session, rising the most intraday in 3 years. Company is poaching the top exec from Rihanna's lingerie brand to lead the retailer's turnaround. Stock still under pressure, though, in 2024. And we know this is a brand that's been struggling for years. We'll see whether or not they can bring some excitement back into it. And then Flutter Entertainment, up about 8% in today's session. It's a $36 billion market cap company. company. No, online, mobile, gaming company, operator FanDuel, online sportsbook, jumping after it reported second quarter sales and profit that beat analyst expectations. So some big outperformers there, Tim.
Okay, you got the outperformers. I got the underperformers. Let's talk about Alphabet. GOOGL, we've been covering the story all day. Shares finishing the day down by 2.3%. As a result of that story that we reported, our Bloomberg News team, late yesterday after the close, that a bid to break up Alphabet's Google is one of the options being considered by the Justice Department after that court ruling found that the company monopolized the online search market, according to people with knowledge of the deliberations. So what could actually happen here? Perhaps a divestiture of the Android operating system, maybe Google's web browser Chrome, or perhaps a possible sale of AdWords, or none of those things, and maybe a different settlement. We'll have to wait and see. Ed Ludlow joining us a little earlier on our program, reminding us that whatever they hear from the Justice Department or from regulators, certainly the company will appeal. Shares of Tencent, or ADRs, I should note, fell as much as 3.6%. That's how they finished the day today. Pressures from a weaker Chinese economy. The segment for fintech in the second quarter recorded its slowest growth since 2022. Tencent's revenue was slightly below estimates, despite stronger growth across the high-margin revenue streams of the company. And finally, taking a check of Starbucks today after yesterday's record 25% increase. Shares falling 2.1% today. Shares gave back a little bit of that gain yesterday. It was down as much as 4.6% earlier in the session. Keeping an eye on analyst reaction as they digest the Brian Niccol news. Starbucks was upgraded to a buy equivalent recommendation over at Deutsche Bank, Evercore ISI, and Stifel. Alex.
All right, getting to the bond market here. If I said a nothing burger for stocks, I got to mean a nothing burger for bonds as well. Yes, things moved, but the moves were very muted. You saw a little bit of selling in the front end. You got yields up on the 2-year by about 3 basis points. In the back end, a touch of buying, but really on the back end, like the 30-year, you had to go out there. The 10-year, nothing doing, guys, on the 10-year.
I love when you talk nothing burgers.
Thank you.
You're very welcome. All right, so one story that caught our attention, we've talked about kind of the rate reset, our moves that we've seen certainly over the last week or so. U.S. mortgage refinancing surging last week by the most since the early days of the pandemic. Borrowing costs, as we know, continuing to drift lower, and that is certainly moving the needle on this one, Tim.
Moving the needle ever so slightly, given that, rates are still significantly higher than they were a few years ago, and given the fact that so many Americans out there who do own homes right now own homes with a mortgage rate that is sub 5%. So significantly lower than what you'd actually get today if you were to refi or buy a new home.
Yeah, and we were talking about the idea that once you started to see those rates come down, you would see a lot of activity. And most people said the initial activity, Alex, was going to be in the refi and home equity space. Alex.
All right, Cisco out with earnings. The big headline here, they're cutting more jobs, and they see a pre-tax charge of up to $1 billion. We had reports that they were going to be cutting another 5% of the workforce. They are cutting more jobs. Let's take a look at their full year 2025 revenue. They now see that coming into $55 billion to $56.2 billion. I do have to say that they upgraded it the last quarter, and they seem to have upgraded it again for this quarter. So, and they're maintaining their quarterly dividend. Scarlett, again, sort of the traditional tech, that hardware tech, continuing to try to transform.
Yeah, in terms of the quarter that ended, we should mention that adjusted EPS did come in higher than anticipated by 2 cents. Revenue was also better than anticipated, $13.64 billion, and adjusted gross margin, 67.9%, so almost at that 68% mark. Analysts were looking for 67.1%.
Okay, looking at what Chuck Robbins is saying, looking at what Scott Herren, the CFO of Cisco, is saying in the press release, quote, as we look to build on our performance, we remain laser focused on growth and consistent execution as we invest to win in AI, cloud, and cybersecurity while maintaining capital returns. That's coming from Scott Herren, the CFO of Cisco.
Kind of one of these legacy tech companies, right, that have been around for a long time, trying to address a market that has been changing. I mean, they've been working on this for some time. This is a stock that's been under pressure this year, off of about 10% year to date. But we are seeing investors like what they got here. And so you've got the stock in the aftermarket, guys, up about 5.1% here. But, that's a lot of jobs. That's really some changes there at that company.
Yeah, it's interesting, too, the commentary, though, about sort of how they fit into the AI space and the idea of sort of helping to protect their customers. And this has been the big thing I think a lot of investors wanted was, can they articulate a strategy of how they fit into all this AI hype and whatever this AI future is going to be? I'm not sure this quite does that, but at least now they're putting something on paper.
Well, also, if you just take a look at some of the areas of growth, right, like earnings wound up beating estimates. Their service revenue also beat estimates. So not all doom and gloom. And you wonder, is this going to be the trough?
Yeah, absolutely. Of course, guys, we are also trying to keep an eye on what's been going on in the world of politics. President Donald Trump, former President Donald Trump, is set to unveil an economic proposal here. He's holding a rally down in North Carolina that we've been told is going to focus here on some of his economic policy proposals if he is getting back into the White House. Let's take a listen in to what the former president has to say.
North Carolina, thank you very much. It's great to be back in this beautiful state with the proud, hardworking patriots who make our country run. You really do. You built our country. You make our country run. I want to thank a very good man, and he's in there fighting. He's fighting, and we know he's a fighter. The next governor of North Carolina, Mark Robinson. Thanks, Mark. Mrs. Robinson, thank you. They're a great couple. Thank you both. Thank you very much. Thank you both. Thank you very much. Well, this is a very frisky group, I have to say. And by the way, we have some very good polls coming out today, I just heard. Despite all of the fake publicity about this radical left person from San Francisco. How's San Francisco doing? Not like North Carolina. No, we have some very good polls coming out, so that's good. You know, considering the fact that what the fake news is able to do, and yet we're leading. And let them have their convention, and who knows how that's going to turn out. Joe Biden is a very angry man. You know that, right? Because they took it away from him. They usurped it. They took it away from him. Terrible, terrible. And I'm not sure that they picked the right guy in him, but he got 14 million votes. He got 14 million votes. He got no votes. And you look at what happens. That's not the way it's supposed to happen. They are a threat to democracy, right, as they say. They are a threat to democracy. But thanks as well to members of Congress, Chuck Edwards.
And that is former President Donald Trump speaking right now at a rally down in North Carolina. We are told that at some point he does plan to outline some of his economic proposals as he is out on the campaign trail. We haven't quite gotten to that yet. Again, he's just getting started here, thanking the folks in the crowd and getting everybody all fired up here. We're going to continue listening in on this. And of course, we will bring you any material news as soon as it happens. Romaine Bostick here alongside Scarlet Fu. This is the close coming off of what was another green day for the S&P and the NASDAQ. Stocks looking for some direction here, Scarlet, on a day where we did get a lot of economic data with that CPI data this morning, the PPI data yesterday, retail sales, and of course, weekly jobs claims numbers tomorrow. And that's the backdrop for some of these policy proposals that we might hear out of President Trump today and, of course, out of Kamala Harris, his opponent in the presidential race later this week.
Yeah, and certainly a lot of people are waiting for that. But in the meantime, they're looking ahead to those data points, which will confirm whether or not the Federal Reserve can move ahead with interest rate cuts next month. But we want to go back to some of the bigger picture policy prescriptions that these candidates have in mind. I want to come in now with Kailey Leinz, who is in Washington. And of course, we'll be monitoring all these speeches from former President Trump and Vice President Kamala Harris. Kailey, what do we know in terms of what Trump is likely to propose? Because he's made comments along the way during campaigns about not taxing tips, for instance, when he addressed folks in Vegas.
Well, certainly, Scarlett, we may be able to draw a clue from the signage that is behind Donald Trump as he speaks this afternoon in Asheville, North Carolina. Not just a sign that says no tax on tips, but also a sign that says no tax on Social Security. This is something else that he has floated as he speaks in general terms about his tax policy. We're waiting to see if he gets specific in a speech today or in the days moving forward as to how exactly he plans to pay for it. Knowing the no tax on tips policy is also one that now has been adopted by the Democratic nominee, Kamala Harris. She called for it this past weekend as well. But the Committee for a Responsible Federal Budget has said that could add $100 to $200 billion to the federal deficit over the last next 10 years. And of course, the tax policy that Trump has said he would like to see, a continuation of the tax cuts during his first administration in 2017, could add trillions of dollars to the deficit as well. So it's the pay for question that we're waiting to see if we get an answer from Donald Trump on.
Yeah, and we're looking, of course, at the backdrop there, no tax on tips, and of course the logo there about Social Security potentially protecting it, which seems to run counter to some of the other proposals that have come out of the Republican Party overall. Do we have any sort of sense here, Kailey, about some of his other economic proposals? I know he hasn't articulated them today, but he is a relatively known quantity, and we've kind of been watching him now for the last year and a half as he's sort of mounted this re-election campaign, if you will, here. What more can we expect on the economic front out of a second President Trump administration?
Well, Ramin, there has been a pattern here when he's asked about fighting inflation and bringing inflation down, given that he does blame the Biden administration and Kamala Harris by extension for the high inflation that the American people have experienced. Consistently, when he's asked that question, he answers deregulation or something to the effect of drill, baby, drill. This idea that if the U.S. could just produce more oil, you could deregulate the energy industry so that they're free to pump more and do what have you, that all of that would then therefore lead to lower prices overall. So the deregulation aspect is something that we expect to be hearing more about from Donald Trump, but he hasn't necessarily gotten specific about what exactly he would like to deregulate where, what specific policies he would like to put forward. Of course, when we think about economic policy as well, some of these populist ideas that both he and J.D. Vance have adopted, it's the question of tariffs. He has said before he would look at a 10% across the board tariffs globally, perhaps 60% on all goods coming from China, but a refining of that policy. If he really is talking about doing blanket policy like that, we haven't necessarily gotten an answer on that. He, of course, is trying to define Kamala Harris very much so in these early weeks of her campaign ahead of the DNC next week. But in doing so and focusing on Harris and with a lot of personal attacks as well, we've struggled to get really firm details on the kind of policy platform Donald Trump would put forward instead of her.
All right, got to leave it there. Kailey Leinz, you can catch her at the top of the hour, the co-host of Balance of Power. And of course, we are going to keep an eye on what the former president is saying at that rally. As soon as he says anything substantive about his economic or other policies, of course, we will break in and bring you that information immediately. We do want to turn back to the world of earnings. Shares of Cisco moving higher here in after hours trading, the biggest maker of computer networking and equipment, giving a bullish revenue forecast for the current period and announcing some cost cuts and job cuts that may help to shore up its income statement and balance sheet. Jin Ho over at Bloomberg Intelligence joining us now. Jin, what was your main take here on this earnings release here? I mean, it still seems to reflect a lot of the same problems, but the reaction by investors here is much more positive than in the past.
I think it's more of relief than anything else. If you're looking at the big concern heading into the print was there another downturn or sustained downturn for Cisco, especially given the rumors of the headcount cuts. And, if I look at the numbers really quickly at a glance, the networking business actually beat consensus expectations just slightly. So it just gives us more of a call of stability than anything else. And from there, we can start talking about recovery.
What struck out at me is the 14% gain in orders, which of course is some kind of indication of future revenue when orders had been flat in the third quarter. What changed here inside of 3 months?
Yeah, so what we're starting to see is that some of the, the inventory glut that had happened on the customer end, they're starting to really work through that. And as you start working through that, customers have to start coming in and picking up some more capacity. We started to hear glimmers of that from other companies. Peers like Juniper start talk about improved order growth. Extreme Networks, it's a much smaller peer talking about order growth, so I wouldn't be surprised that Cisco is seeing that follow through as well.
All right, good stuff. Jin Ho of Bloomberg Intelligence giving us the instant analysis here on Cisco's results. And Cisco, as you can see, moving higher in after-hours trading. We want to fold in the spate of tech earnings that we've gotten this earnings season along with the broader markets. And for that, we turn out to Mark Lehmann, head of Citizens JMP Securities, who has been looking at everything alongside us. When it comes to tech earnings, I feel like we managed to get through big tech with a very mixed picture, right? Everyone just wanted proof that all that spending was paying off somehow. But if the bar was low, then companies were able to surprise to the upside. What's the mood heading into the next big tech earnings, which is NVIDIA?
I think the mood is certainly more optimistic than it was a week ago. And I think there was great differentiation between the Magnificent Seven, which I think is really important because there were some really stellar numbers and some stellar outlooks, and there were some that were muted. So I like that. I think a market that is more specific about companies as opposed to just saying they all trade the same way. Even just saying the Magnificent Seven versus the FANG stocks, which we don't say anymore, it tells that.
I think it became Famaga at some point.
I called it Mount Fang because I added Microsoft and Tesla, but that's a little different.
So when you look beyond the technology and you look at the rest of the companies that have reported earnings, how concerning are the warnings from companies that have exposure to the consumer and the way that consumers seem to be much more selective about their spending? They're not necessarily holding back, they're just restraining some of their spending compared to last year.
It's noticeable, and you see the haves versus the have-nots. And I think it's very telling the people who are pivoting and making sure that they have the right offerings for consumers. So you've seen that obviously with McDonald's. You've seen that obviously with other companies who are honing what they're doing. And it's been very glaring how well the companies that have pivoted and prepared for this are doing. And similarly, the companies that overspent and are still not over that kind of COVID high are paying for it right now. So those inventories that are being worked down and some of the pricing pressures that have to abate because, frankly, people are not willing to spend, like we saw up until yesterday, $10 every day for a latte. And you got to make sure the consumer's happy with that $10 latte.
That's the consumer side of the equation. What about corporate spending?
Listen, at Citizens, we have a big footprint. So as a trusted advisor for a lot of companies, we've heard a lot. I would say last week when things were really in a panic mode, there was no panic anywhere. We didn't really see that on our trading desks across equities, across fixed income, et cetera, which tells me a lot, which is that the consumer is definitely slowing down. The corporate America is ready for that. But this fear and panic that this is some global recession or some global diminution in demand, I just don't see it. We don't see it.
Do you think when we talk about, particularly when it comes to tech stocks, and I mean, you kind of still, I guess you could still say San Francisco is the seat of tech, right? Although some of that's moved a little south and a little east, but you're still kind of the center of it. And I am curious that when we talk about kind of the innovation machine, and I know everyone went gaga over AI because this was like the next big thing that tech was fun to finally give us, whether that materializes or not, still to TBD. But are you encouraged here about what these companies are doing, how they're spending that money, and the ideas they're coming out with?
I am. I mean, some of that is, and we're going to find out not today or tomorrow, but in a few years if it is overhyped. But I don't think the results of that investment are overhyped. I think the changes that are going to happen to our day-to-day work and our day-to-day engine here, R&D engine in this country, are going to be absolutely substantial. Whether those investments merited such a big investment at these lofty valuations, we're only going to learn in hindsight. But again, I think this innovation engine that's accelerating for both tech and life, we call that a horizontal, not a vertical, because that's what AI is.
Where are these companies right now? Because it's funny, we talk about the Mag 7, right? But we talk about this idea, there was a reason why everyone invested in the Mag 7, because if you wanted tech and you wanted reliable tech stocks, that was pretty much it. But there's all these companies that are private that I think a lot of people would love to get their hands on. And I guess you can to a certain extent if you have the right connections. But when do those companies come to the public market?
It's a great question. I would have expected, because the backlog in IPOs is there's a glut in the backlog. But what I've also seen is that the IPOs that have happened to go public, the Reddits of the world, the Oddities, et cetera, they've worked. The stocks have done extremely well. And I talk to portfolio managers every day, and they're wondering why are they not coming to the public markets. There is a disbelief that there is an audience, and I think some of the big investment banks proffer that notion. But when I talk to portfolio managers, they're willing to make earlier investments for things they believe in. So I don't expect the fourth quarter to see that robust turnaround. We have the election, we have this backdrop of interest rates, but the demand is there, and I expect 25 to be a much better demand environment.
Mark, really appreciate your joining us today. Mark Lehmann is head of Citizens JMP Securities. And it is that time of the year when earnings season is largely over, and we get the 13F filings that shows us what the big investors are doing with their positions. And of course, it's a snapshot in time, Romain. It's not really a moving picture. So we don't know exactly what they're doing with it, but it does tell us that they've started to buy or started to sell some of their big holdings.
Yeah, we know exactly what they held at the end of the quarter here. So whether they've sold it or bought more, who knows here. But a couple interesting ones. Ulta is actually the biggest biggest mover here in after hours trading, finding that Berkshire increasing its stake significantly in that and in Sirius XM, ticker SIRI, which I don't know. That one's kind of a contrarian one to me because I always thought this was a company that was kind of circling the drain. But anytime Berkshire invests in a company like that, you kind of have to poke your head up and say they clearly see something that the rest of us don't.
Yeah, everyone is going to be taking a closer look at that. We'll continue to monitor these headlines here as we get more 13F filings. But for now, you're looking at gains in Ulta and SiriusXM. This is Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Tay-Tay, Taylor Swift, responsible for driving a 30% bump in the Kansas City Chiefs fan base. That's according to the team's CEO. So she first showed up at Arrowhead Stadium for the Chiefs' second home game versus the Bears in September. Apparently, Romaine, she didn't want any special accommodations, and she preferred to walk through the stadium's front gates. The security team was like,
she's just a person of the people, woman of the people here.
But she sparked a frenzy.
I'm sure she did. Everywhere. I'm sure anywhere she walks through, she's going to spark a frenzy here. Yeah, this is great. Can I just scam myself and say this out loud? I'm kind of over them, this Travis and Taylor.
Really?
Thing. Yeah.
You don't see a love story coming?
I don't. I kind of want them to break up.
Oh my God.
All right. Now that
Speaking of causing a frenzy.
Okay, now let me dodge the follow-up question from Scarlett there. Let's move on to our second person that we're keeping an eye on. His name's Dwight Scott. And now for a lot of people not on Wall Street, you might not have heard of him, but he was the man who built Blackstone's credit operation. It's a $330 billion behemoth. And we're now learning, based on an internal memo that Bloomberg reporters got, that he's retiring from the firm. It's not an overstatement to say that he is not just a pioneer, but really a titan in this space here. And now let the speculation begin as to what he's going to do next. I think let me just double check. He's only 61.
I know, so he's got room
on Wall Street,
space
that leaves him a few more years to do something
Second
else.
act, third act, fourth act. Actually, this would be the second act, right? Because he came to Blackstone from GSO Capital Partners, which basically jump-started Blackstone's credit business. He's 61. You said Schwartzman is 77, so that's another 15 years for him to do something.
Yeah, there you go. And make even more money.
All right, well, keep an eye on that. He'll be another top three at another point. Third on the docket is Bob Jordan. You may also not have heard of him, but he is the CEO of Southwest Airlines. The carrier, by the way, standing by its man after activist investor Elliott Investment Management proposed overhauling Southwest board. That includes Jordan and also the chairman, Gary Kelly. We know that Elliott has criticized both of them for poor execution and stubborn unwillingness to evolve the company's strategy. Of course, I was just taking a look. It should be pointed out, as we were talking about 13Fs, the latest 13F from Elliott Management is out. And of course, it confirms what we already knew, which is that they have been amassing the stake. In fact, that was their biggest new buy in the most recent quarter, Southwest Airlines. They've been a very activist investment shop over there. But you know, Southwest has made a number of changes, or at least announced a number of changes, right? They're going to add red-eye flights. They're going to add this new premium class option, and they're getting rid of free seating. So they're going to add assigned seating.
I always see, when growing up in Chicago, Southwest was like the greatest thing because it was so simple.
Yeah.
And, no extra fees. And, everyone just sit where you want, blah, blah.
Free
now they're just turning into just the cluster that is everyone else.
They're nickel and diming everyone just like everyone else.
All right. Scarlett, I got to get me a private jet. How do I get one of these things? All right, when we return, we're going to take a look back at the biggest blackout in North American history. Huge ramifications for the economy. That conversation coming up next here on The Close. This is Bloomberg. Let's look back in history. On this day back in 2003, New York City, the financial capital of the world, went dark. A 29-hour power outage that ranked as the biggest in North American history and second largest ever anywhere in the world. Now, the drama started shortly after 4 p.m. on August 14th when a 9-second event occurred on a small patch of the electric grid in Akron, Ohio. And now an alarm that was meant to alert utility operators failed to trigger, and that caused a single sagging power line in the Midwest to cascade into a multi-state, multi-nation, multi-billion-dollar catastrophe. All told, at least 61,000 megawatts of power, affecting at least 50 million customers, were lost across Ohio, Michigan, Pennsylvania, New York, Vermont, Massachusetts, Connecticut, and New Jersey, as well as in Ontario and Quebec, Canada. Here in New York, The power failure, it closed the nation's biggest transit system, forcing 5 million would-be subway passengers to fend for themselves on the mean streets of New York, streets where all 11,000 plus traffic signals ceased to work. Mobile phone service was disrupted as cellular towers lost power. General Motors, Ford, and Chrysler suspended work at 55 car factories across the region, and airlines canceled flights for hundreds of thousands of passengers worldwide as airport systems for booking, securities, and traffic control went down. Now, the blackout also was the biggest test of Wall Street's resilience, the biggest test since September 11th. It was a test that Wall Street actually passed. U.S. stocks, believe it or not, were a little changed that day in what was one of the slowest trading days in history. And the New York Fed's payment systems and open market desks, well, they function normally, and that's a good sign. Nationwide, though, it was estimated that the blackout led to around $10 billion in direct costs and lost revenue for businesses and households alike. A blackout so big and disruptive that even U.S. President George W. Bush weighed in on the need to upgrade the electrical grid, a clarion call that 21 years later has not been fully heeded.
Yep, add that to the long to-do list. I kind of remember there was a baseball game that day and Derek Jeter talking about how it was actually kind of refreshing for them to play baseball without the power on because they were able to play without all the bells and whistles and all the sounds and, you know, the clap your hands and the T-shirt party patrol guys everywhere. It was the game went really quickly, if I recall correctly.
That sounds great for the players, but for the fans.
Yeah, well, he enjoyed it.
Yeah, okay.
I might have my memory wrong here, but I seem to recall that. Anyway, let's move on to the economic data. And of course, the report of the day was CPI. It posted the smallest 3-month increase in core inflation since early 2021. So that keeps the Fed on track to start cutting rates, that is, next month. Kathy Bostjancic, the chief economist at Nationwide Mutual, joins us now. Kathy, I talked with someone else earlier who said that the inflation genie is back in the bottle. Do you agree with that?
Hi, Scarlett. Happy to be with you. Well, I think largely that's the case. It was another very good inflation reading. We've had 3 in a row, and I would say even the one prior to that, maybe say 4 that were rather good. I think it gives the Fed enough confidence to start cutting rates in September. I'm not sure that it's enough to tip the scales towards 50 basis points. Probably they start conservative 25, but the one part of the report that I would say is like kind of the fly in the ointment was the housing inflation number, right? Shelter inflation was up 0.4. And the reason I say this, last month we all got very joyful that it was a low print and thought, okay, now this is finally turning, right? We've been anticipating this for well over a year that rental inflation was going to turn down. The fact that it reaccelerated in July, that's a little bit of a concern.
It's a little bit of a concern, but shelter inflation, I think auto insurance was also higher as well. Are these lagging indicators, meaning they're just reflecting things that, like, over time catches up and therefore, they're going to start declining as well? Or is there still more room to go in those two areas?
Great question. I think, the rental inflation, all of the data that we use to forecast that points to slowing, so deceleration in shelter inflation. It's just that it's still taking so long. It's been longer, the lags, than the model suggests. And it does raise this question, is something broken there or something different? On the motor vehicle insurance front, we did get another big increase in July. I think, over time that should moderate as well. I think that if you look at things like repair costs, which rose a lot after the pandemic, motor vehicle insurance, the level of that insurance is now caught up to rental repair costs. So that makes it, there's less pressure in that sector going forward. Doesn't mean you can't see some still sturdy increases, but I think the worst of that increase is behind us. But again, the shelter is really problematic because it's such a big share of inflation.
Well, that's what I'm curious about, too, because there's a lot of people celebrate some of these numbers, these sort of, I guess, disinflation type of reports that we've been getting here, Kathy. Kind of lost in it is how much damage has actually been done so far. I know there's been a lot of anecdotal evidence of lower end consumers pulling back already, but should we be a little bit more focused on the damage that has already been done and how that affects the psyche for whether these consumers are going to continue spending no matter what the data says?
It's certainly it's taken a toll on consumers. Now, previously there was big tailwinds. There was a lot of pandemic savings that consumers could tap into. Also, households were turning more to credit card usage. But low-income, younger users of credit are really increasingly maxed out, and we see delinquency rates rising for credit card payments and autos, and that's at a time when the unemployment rate's still really low. So that's a concern, and I think that does weigh on the consumer. And I think the fact that the price level, except for certain categories like used car prices, the price level is not going to go down. It's just that the inflation rate is moderating. So I think the consumer's feeling fatigue here, and I think the other thing I would say is that consumption is now more in line with income. So if the labor market continues to moderate, so will consumer spending.
Mm-hmm. It was kind of interesting, too. I mean, there was a great quote that we had from Krishna Gua over at Evercore. He's quoted in a Bloomberg story that talked about, and I'm just going to read the quote exactly. He says, basically, this is a labor data first Fed, not an inflation data first Fed. Does that sound right to you?
I think it's more in balance. I understand where, the point he's making. Prior to this, it was all about inflation and employment took the back seat. I think they're now both in the front seat, but I wouldn't say that they've completely, focused on employment. And the reason I say that, again, is that it's a shelter. It's sticky, and it's really hard to get service inflation down. The thing I worry about is the airfares that have been down the last 2 months in a very large way. Is that going to continue to offset the shelter costs? And the same thing with used car prices. There's going to be some limit there, and that's the concern that I have.
Kathy, really appreciate your joining us. Kathy Bostjancic is chief economist at Nationwide Mutual. And of course,
you know what would be a sign of things coming down?
What's that?
If they started letting me back into airport lounges again.
You're still steaming mad about that, aren't you?
I am.
Yeah, you can't get into airport lounges with a business class ticket anymore. We learned the hard way. You need to be flying international, or you need to have like the specialty credit card, or
be like the ultimate first class premier platinum customer or something.
Yeah.
You are a platinum customer somewhere, right?
No, not
Costco
the right places.
or something.
Yeah.
Right?
Yeah.
Does that get you into an airport lounge?
If only.
Well, can you imagine if Costco got into the airport lounge business?
I would pay double the membership fee for that.
You would.
The Costco airport lounges would be massive. Just think about that.
That's right. Yeah.
Oh, we could reimagine
all
everything.
the paper towels you ever need.
Let's take a look at how markets closed on the day. Overall, an up day here, but it was kind of all over the place for a while here. And the NASDAQ really a laggard here when it comes to big tech names, especially Alphabet, because of all the talk about how the DOJ might break apart Google.
Yeah, and it's kind of interesting, too, because we talk about it being somewhat lower volume. Obviously, we're in mid-August, a lot of people not at their desk. But there are a lot of people that have made a conscious decision just not to trade this market right now. They really do want to wait till the Fed actually gives us more clarity, a few more data points, and maybe even they're waiting longer than that because they're scared of the election.
And also NVIDIA to report, right?
Oh, yeah,
that's
NVIDIA
at the end
too.
of this month.
Yeah,
so
absolutely.
Don't touch anything until that happens.
Yeah, absolutely.
This is the close on Bloomberg.
Walmart, it's set to report earnings before the bell tomorrow. The street looking for about 3.4% growth in comp sales, roughly about $169 billion in revenue and 65 cents on the bottom line adjusted. Corey Tarlowe joining us right now. He's over at Jefferies, and he's actually raising the estimate for the retailer's second quarter comp sales to 4%, up from 3.5%. So, Corey, you're actually above consensus estimates right now. What gives you that kind of confidence?
So the street's closer to 3, as you mentioned, and we're at about 4. And it's really driven and grounded in data. So all of our estimates that we do for a lot of our larger cap, value-focused, food-oriented retailers is very data-driven. And so we have, thankfully, a great data team at Jefferies that works very closely with all of our vendors and with us. And we've been able to triangulate really footsteps in the door at Walmart on a quarter-over-quarter basis.
And what are you seeing?
What we've seen is that the data is actually accelerated. And
so more people coming in.
More people, new customers coming into Walmart, existing customers shopping more. And that's what's driven really the upside to our estimates.
Are they spending more? Is there any sense that do we know that?
So
are the tickets larger, the individual receipts larger?
The tickets are about flattish.
Okay.
So pricing's been about flat overall. At Walmart, we saw pricing flat in the last quarter. You'll probably see it flat in this quarter as well.
Okay, and that's really interesting given that the macro data shows inflation is definitely slowing down. CPI and PPI confirm that. In November of 2023, Walmart used the word deflation on their earnings call, talking about prices coming down rather than just a slow increase. Do you think we're at that point where that's going to be a theme again?
Not quite. But there are certain areas within Walmart's business where they're actually seeing deflation. And
where's that?
Probably the most important area is in their private label business, which in the U.S. is actually in excess of $100 billion. And so that private label business is growing faster than the overall enterprise. And by the way, it's higher margin. And in an environment where you're seeing consumers trade down, where you're seeing consumers trying to stretch their dollar a little bit further, a great way to do that is to not necessarily buy the brands that they know and love, but maybe shift into a store brand that has the same quality of the branded products, but at a much cheaper price.
Is that only for Walmart, or does that apply to Sam's Club as well?
It applies to Sam's Club. It applies to Costco. And in fact, I actually just recently met with Walmart management, and one of the things that they mentioned was that their price gaps, if you compare the branded items that they offer to their private label products, is that you're actually seeing those price gaps be the widest they've ever been in company history.
Where's the competition right now? Like when we think of Walmart, I feel like a few years ago we used to kind of do a direct comparison with Target. I'm not sure that's as fair of a comparison. And if we are headed towards a softer economy, which many people think we are, I would think that would maybe actually boost some of like the kind of dollar store competitors, although they're not really dollar stores anymore.
$5 stores.
Does that not apply?
Well, I think it's important to note as you think about dollar stores, if you just look at Walmart's midweek business as an example, because you highlighted dollar stores as a competitor. Walmart's midweek business for its pickup and delivery is up double digits. And so if you think about the efficacy and the utilization of a dollar store type model, it's about going to those stores when you need to go to them because they're convenient and that you can get what you need and get out very quickly. But Walmart's always done well on value, but now their convenience is getting better and better with buy online, pick up in store, buy online, ship to home, their Walmart Plus offering that they've rolled out and is continuing to grow double digits as well. So that convenience element has really elevated their competitive edge over certain competitors like the dollar stores, like a Target, et cetera.
As far as like kind of the long-term trajectory for this company, there was a lot of talk when we learned about the Vizio acquisition and sort of what the rationale behind it was. I know there was some speculation it was about ads, some of it was about data. What do you think it was about, and when do we start to see them talk about that a little bit more as to how it's going to be folded into the business?
So Walmart's advertising business is really core to driving more profitable, predictable growth ahead, because the advertising revenues, they're around $3 billion today, and they're growing double digits, but the margins are 60 to 70% or even higher. And so if you compare that to Amazon, for some perspective, Amazon's advertising revenues are $50 billion. So the opportunity for Walmart to scale this is absolutely massive, and that'll underpin a lot of profitable growth. Vizio fits into this such that Walmart can advertise online on their marketplace. They can advertise in stores, which Amazon really can't do to a great degree because they have Whole Foods, but they don't have much else. And then on TVs. So it gives Walmart an additional avenue to actually push their advertising revenue and advertising product through to consumers.
That is a lot to think about here, especially for a company whose revenues on a quarterly basis is $168 billion. Corey, thank you so much for joining us today. Corey Tarlowe is Senior Vice President of Equity Research at Jefferies, and of course, Walmart will be reporting earnings tomorrow morning. Now, for those who thought supply chain disruptions were over, think again. Labor issues this fall could make things problematic for retailers like Walmart. Port workers along the East and Gulf Coasts are threatening to head to the picket line in October. The drama comes at a time of heightened turmoil in the shipping industry, driven by the ongoing crisis in the Red Sea and drought conditions at the Panama Canal. And timing-wise, a walkout could overlap with the election in November. Joining us now for more on this is Jess Dankert, Vice President for Supply Chain for the Retail Industry Leaders Association. Jess, thank you for joining us. Give us a better sense of what's at stake here for the retail industry. How much product moves through these ports, and what's usually in the shipping containers?
Yeah, thanks for having me. You know, this is a critical time for supply chains and critical for retailers. We're right in the middle of peak shipping season, heading into, right now it's back to school, but ahead of that we have all of the fall holidays and then winter holidays as well. So this is the time when everything is moving. So while the contract expires at the end of September and a strike could happen on October 1st, right now is a time of great uncertainty, and uncertainty is kryptonite for supply chains. So those question marks are making retailers need to put contingency plans into place to make sure there aren't going to be any surprises come this fall.
Yeah, well said. Kryptonite for the industry. So you mentioned that the current contract expires at the end of September. Do we know how negotiations are going so far? What is the retail industry? What is its awareness on whether the two sides are even negotiating, whether any progress has been made?
Yeah, the negotiations aren't really going right now. They were called off in early June, about the day before they were supposed to restart. So that hasn't been promising. Right now, the two sides are pretty far apart on some key issues. There were statements over this past weekend kind of illustrating how far apart they remain. So what's really critically important is for those two parties to get back to the table and find some sort of resolution in time, well in advance of that expiration, and take that uncertainty out of the system.
Well, given that uncertainty, is it too late for folks that need their goods and need them some point in the future to sort of front run this, to basically try to pull a lot more of this into the country now before we get to October, or does that not really, that's not how it works?
That's what retailers have been doing, really, because the uncertainty is so risky for supply chains. Retailers have been either pulling shipments forward, front-loading the season, which has affected kind of the picture or the outlook of peak season generally, moving a lot of those forward, and also diverting shipments to the West Coast instead of the East and Gulf Coast, so that we're not going to have any of those surprises. You know, retailers have really, especially over all the disruption of the pandemic, have developed a playbook to avoid any sort of disruption, ensure that those products are on the shelves, on the doorstep where consumers need them.
Yeah. Well, one reason I asked that too, and I'm just curious that when you're talking to the members of your organization and other folks in the industry here, is there any concern here about over inventorying? We went through this before, of course, I don't know, was it 3.5, 4 years ago? And some companies, of course, overdid it. And of course, they ended up sitting on a lot of product that they couldn't move, or at least not move at the price that they thought they would be able to sell it for.
Yeah, and this is a different sort of situation. This sort of uncertainty and challenge isn't driven by a massive, striking consumer demand like we saw during the pandemic, that there was some potential overreaction to that resulted in a lot of overextended inventories. All of that's been kind of right-sized by now. And this is just the ordinary, inventory that's been forecasted for the needs that we're seeing the strong consumer demand for heading into the fall and holiday season beyond.
Jess, how big of a topic of conversation is this among retail executives? How high is it on their list of worries that they really need to address right away?
It's something that everybody's watching. Everyone's keeping a really close eye on it, including the administration and the federal government. As you mentioned, the timing. Retailers are really watching it closely, but they're not sitting around waiting to see what the outcome is going to be. They've already put those contingency plans in place to make sure that merchandise is going to be where it needs to be. The retail industry and shopping is, those timelines are a bit unforgiving. Nobody needs Halloween costumes on November 1st. So they really need to make sure that things are where they need to be for consumers, where and when the consumers need them.
All right, Jess, great stuff. Really appreciate you taking time for us. Jess Dankert there.
Thank you.
She is the Vice President of Supply Chain over at the Retail Industry Leaders Association. When we come back, we're going to set you up for what to watch over the next 24 hours. This is Bloomberg. It's been another busy day in financial markets. Tomorrow could be even busier. A lot going on. Here's what to watch over the next 24 hours. And we're going to start off, Scarlett, with earnings out of some big companies, too.
Yeah, Walmart, the world's biggest retailer. That'll be fascinating, especially since it's such a big read on consumer spending. By the way, this is a company that's going to book $168 billion in revenue for 3 months. It's hard to get your head around that.
Yeah, you'll get a nice read on the consumer there. I'm interested in Deere as well. Of course, a read here, I guess, on the agricultural and farm economy. But I almost forgot about Alibaba. I mean, I have no idea what's going on in China right now because it seems like every headline is a bad one here. Is that going to give us some insights?
Maybe. We know that the Chinese government is not looking to stimulate the economy right now. Yeah. So Alibaba will definitely give us some kind of sense of how much Chinese consumers are pulling back on their spending. Yeah,
I'll be keeping an eye on that. A lot of that coming before the bell. Also coming before the bell, we get some economic data and also some big ones.
Yeah, retail sales is going to be the key one here. And of course, there was an unexpected drop last time because of the cyber attack at auto dealers. So you're going to wonder if that's going to be made up this time around.
I completely forgot about that. Yeah. I'm just so focused on like the people buying apparel and other things. I forgot about
cars.
But this could be a pretty momentous one here as we kind of put together this economic picture of what's going on. Those weekly jobless claims numbers, which surprisingly ended up being one of the most tradable data points last week. I'm not sure that's going to get a repeat of that, but we'll keep an eye on that. And I know you love Fed Speak.
Yeah, Fed Speak. After all the big inflation data is coming out, we've got Muslim, we've got Harker, and by the way, not mentioned here, the drop of the season 4 premiere of Emily in Paris on Netflix.
All right, we'll have a full recap of Emily in Paris. Join us tomorrow. Balance of Power is up next.